Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Phil. It's great to have you back on the podcast show.
Great. Thanks, Bilal. Great to see you again.
Well, when we look at the macro picture, it seems like we're at an interesting juncture. One thing that many people have been surprised about has been the strength of the US economy. It wasn't meant to be as strong at this stage. We were supposed to be in recession by now. So perhaps we can start with that. What are your thoughts about this seemingly surprising, at least relative to consensus, strength in the economy?
Sure. No, I hear you. And, I think the coming recession has been, a theme of mine, and it remains a coming recession in some sense. And I'll talk in a minute about why I think still 24 is going to be a rough year. But in terms of kind of looking at 23, let's say, I think there is no doubt. I mean, I look at my forecasts, I revised them down sharply when the Fed began to accelerate its tightening process in the late summer of last year. And then I've had to sort of revise them back up as what I thought would be a significant effect has yet to show through. I'd emphasize that I think people maybe got a little ahead of themselves in thinking the economy was going to be very weak in the early part of 23. And of course, we had the banking problems in March, which really sort of made everyone thought, yes, it's here. And I always felt that was a little premature. But I think the surprise to me has been what's happened in the second half of the year and the resilience of the economy, most notably, perhaps the resilience of the consumer. I do think the July retail sales reading was an outlier on the high side. And in fact, this Friday, we'll get a payback for that. But the underlying trend, I think, remains more solid than I thought. And I think it comes back to this basic point that the economy can withstand higher rates maybe a lot better than people thought a few years ago. I wouldn't call it the equilibrium real rate, but the sort of real rate the economy can stand is in some sense much higher than the estimates that were flying around, including those still being published, for example, by the New York Fed.
Yeah, and why, say, if we zoom in on the consumer, I mean, interest rates have shot up, yet the consumer hasn't really stopped spending as much as one would have thought. I mean, what is it about the consumer today that's different from, say, the 2000s or earlier hiking periods, in the early 90s, say?
Yeah, I mean, well, I think fundamentally what drives the consumer is solid income growth. And of course, one thing that's happened this year versus last is that we've seen a big drop in gasoline prices. I mean, that's reversed in recent weeks, but partly. But, the consumers had a break from the big fall in headline inflation. And wage growth remains solid. It's not leading the inflation process by any means, but employment growth is okay and wage growth is okay. I think the other factor, which I think is relevant, I wouldn't make too much of, but certainly worth bearing in mind as we look over the next few weeks, is that a lot of consumers, around 44 million of them in the younger cohort, got a nice break from the fact they didn't have to service their student debt for, over 3 years. But that debt service requirement started again on September 1st. So there'll be an interest drain on that cohort in the fourth quarter that, I estimate will be something like around 4/10 of personal income. So, that'll be in addition to what the Fed's doing and the way that's percolating through higher rates, that will be a little bit of a drag from higher rates on the consumer.
And when we look at the labor market, everything seems to be sort of slowing. Payrolls, sort of the average payrolls, you could say, is kind of heading down. Revisions tend to be a bit lower as well. Job openings are lower. So everything kind of heading down. How do you interpret that? I mean, does that sort of tell us that, okay, we're going to sort of fall and have a sudden drop and that's the recession, or will we just have a very sort of gradual decline until we get to zero or negative?
Yeah, I think we're in that phase where we're seeing clear signs of deceleration. And, I guess now what the market is priced to is the notion that will stop and will keep going at a slow rate for an extended period. I'm just a little, as mentioned earlier, I still have a view that 24 will be a rough year for the economy, and that the lags of tighter monetary policy will really be at their peak in that period. And I think that's when the labor market begins to deteriorate in earnest. And I think the only statistic we haven't seen make a meaningful move in the labor data are the jobless claims data. They've come off their lows, and I thought earlier in the year they were beginning to make a more sustained rise, but they leveled off through the summer months. And that's been that. You could say it correlates strongly with the strength of the consumer. That's been the surprise to me in the US economy. And I think that's more of a temporary lull. And as we go through the last part of the year and into next year, I think tight money will buy more and more. And the theme will be growth disappointment.
And then other economists, and Dominique's one of them, when I interrogated her about the US economy, she often points to the fiscal stance as being something that's very supportive for the economy. I mean, do you buy into that or not?
Well, yes, I think there's two ways to think about this. One is, in the big picture sense, fiscal has, was very expansionary in 21 and 22. Sorry, 2021, much less so in 22 because, the economy recovered and we could withdraw a lot of the stimulus. In 23, I think we've been surprised by how much the deficit's widened. And I think we're all scratching our heads a bit to understand how much of that is genuine stimulus and how much of that is sort of one-off flukes. I mean, clearly one thing that's happened is tax payments have been much lower. And I attribute that to the fact that people basically made much less in the stock market in 22 and paid much less in the way of capital gains taxes in 23. That will obviously reverse somewhat as we go into the next tax season. But I think on the spending side, one complication is some of these data related to the student loan programs, which I mentioned earlier. We saw not just the forgiveness of interest and principal, the requirement that students didn't have to pay, our former students didn't have to pay interest and principal until September 1st. We also had the Biden administration try to push through student loan forgiveness. And that led to a very big, they accounted for that in September of 22. And we saw a very big rise in the deficit, which is still in running 12-month numbers. But actually, when we get some numbers later today for August, they'll reverse that effect. So the deficit on a rolling 12-month basis through August will actually drop quite sharply. And I don't know how to, conceptually, I'm not 100% sure how even I think about those fiscal swings, because you could argue, yes, there was a genuine transfer from government to poor people, to poor students from this debt relief plan that then got reversed when the Supreme Court unwound it in the summer. So maybe that represents in some sense a stimulus and then a de-stimulus. I'm just not sure. I think as Keynesians, we tend to look at changes in the budget deficit and say, that's driving aggregate demand. I think this time around it's a little less clear. Now, having said all that, there are clearly some underlying things going on the fiscal side, which are the lagged effect of some of the things Biden did in his first year or so, first couple of years, including the infrastructure program, and now increasingly the so-called IRA, the Inflation Reduction Act, which are clearly providing some investment support.
And when you, speaking of investment, when you look at the investment cycle within the US, I mean, how would you characterize it?
Again, somewhat surprisingly solid. I mean, I think you break into its various pieces. I mean, housing was very weak last year, and I think has been, in some sense, surprisingly strong this year, although I think that won't last. Business equipment investment has been sort of sluggish, and I think it's following the trend. Business structures investment is the interesting one to me, because I would have expected that to be a lot weaker because of things like weak office construction. But in fact, we've had, for want of a better word, we've had a boom in factory construction. And that wasn't something I saw coming. And again, maybe that speaks to the role of things like the IRA and the infrastructure program. But there may be some sort of non-interest rate effects going on here that are pushing up business investment, including obviously the the energy transition, including in the auto sector, towards greater EV production and consumption.
And you said earlier that 24 is going to be a lot more of a rough year for US growth. One reason you said was lagged effects of tighter monetary policy will start to feed through, and that will have a hit to the economy next year. Are there other factors as well?
Well, I think the fiscal picture that I mentioned is one of net tightening as we look into next year. I talked about the tax payments going back up again, not because of any higher tax rates, but because of lagged effects on capital gains. The fading of spending through, including especially the student loan. This increase in student loan debt payments, modest number, but around the edges, notable. And then, of course, somewhat of the unknown is what's going to happen to spending levels in the next fiscal year, once and if we get some kind of fiscal agreement on the budget for fiscal year 24. I mean, that will be a very interesting Washington topic for the next few weeks and months. I think we're headed for a government shutdown at some point, frankly, probably October 1st. And that in itself is a drag. But I think the bigger issue is how much restraint can and will the Republicans impose through their House majority. I wouldn't bet on a lot, but I do think the spending growth that we've seen in recent years will be diminished. And then, of course, the final point here is the sort of running out of the excess savings that we had built up in 2021 and 22. One way of thinking about the sort of last hurrah on this is that one of the things that's given us a bit of strength this year, quite a lot of strength, I think, is the rebound in the auto sector. As producers have finally been able to make cars and sell them, and strong car sales have been an important part of both solid business investment and especially solid consumption. And I think that process will tail off as we go through this year into next, and that will add a drag to demand and to growth.
So there's kind of an auto cycle we need to be aware of, and that fading as we go into next year. Yeah,
absolutely, and that it's something you see in a lot of the DM countries. I was struck looking at the data this morning from the UK. We had some weaker data for July, but when you look at UK auto production through the spring and into the summer, it really rebounded very sharply. It's begun to fade a little bit in July, but the UK is another good example of a country that's had this big manufacturing boost from a mini auto cycle that I think it's not related to everyone suddenly deciding that we feel rich and we want to buy a car. It's that they're just there to buy these days. They weren't a year and a half ago.
Yeah, I noticed, I think perhaps in your writings that you talked about this as well, Japanese auto production, obviously China auto as well. Germany seems to be lagging for some reason. Yeah. Do you have any ideas why Germany hasn't participated in this auto cycle?
Well, I think that's a more structural problem. Germany, I think, is, in some sense, is participating in it. It's just that German production would be a hell of a lot weaker if they didn't have this lift. You know what I mean? And I think the problem that Germany faces is looks to me a bit like an auto sector that, I remember growing up in the UK in the 70s and 80s, everything just seemed to go wrong with the UK auto sector. Eventually it sort of imploded, and same was sort of happening in the US. And, Germany was the strong one and survived and flourished. And I wonder a little bit if, especially with the growth of Chinese production and Chinese exports, whether Germany is now vulnerable to some of these problems that sort of beset DM auto sectors, 30, 40 years ago.
Yeah, I can relate to your anecdote about the UK because I grew up in Cowley in Oxford, and there's a Rover Car Works in Cowley, which then is mini now, and there's some talk about that being shut down at the moment, I think. So yeah, it carries on the UK story there. Now, if we move on to inflation, we had data out on Wednesday today on inflation. So CPI, if you kind of strip out like all sorts of different things, it seems like we're running around 4% ish, core inflation. we're not at 2, which is the target,
Yeah.
for the Fed. And so, what's your forecast here? I mean, how hard is it for us to get down to 2%, and what will be needed for us to get down to 2?
Yeah. So the irony is I've changed my growth forecast continuously and regularly and sizably and all that. I haven't changed my inflation forecast now for about a year and a half for the US, which is, amusing in some levels. I mean, I basically forecast, I mean, putting some round numbers on it, inflation to be around 3.75% by the end of this year, and then down to 3% at the end of next year. So the 2% outcome is very elusive. And the way I think about it, and I think we've talked about this before, is you're best off thinking about the inflation process as in some sense a bottom-up process. With goods pricing being the key ignition factor, and also, if you're thinking in sort of fire terms, it's also the fire retardant. It's the thing that puts the fire out. When goods prices collapse, that's what gets you into lower inflation. What's happened with goods pricing is they've stopped being the ignition, but they're not collapsing. And I think that's a very important point, and that probably has something to do with the state of global supply and demand. We've not yet created excess supply in the way that will put a lot of downward pressure on key goods prices, and oil would be a good example of that. So on the goods side, we've stopped the inflation, but we're not getting deflationary pressures, with perhaps one notable exception, which is China, which I think is providing more of a service to the rest of the world in terms of exported goods deflation than it was certainly 6 to 12 months ago. But then on the services side, I think what we've got here is the classic case of sort of lagged adjustment as relative prices adjust up. Service producers raise their prices on a more regular basis. And I think what's really important is the sort of whole environment for pricing has shifted from the last 10 years, or the 10 years before the pandemic, let's say, to one where instead of no price increase being your default, or a modest price increase, I think more and more producers are going to kind of lock into the idea that 3% is reasonable. And you could say, if I was using central bank jargon, I would say that's a reflection that longer term inflation expectations have not become de-anchored. They've just moved up a gear. And I think that's probably where we're going to settle. That doesn't mean to say the Fed can never cut interest rates. We'll talk about the Fed, I'm sure, in more detail, but I think what it means is that where the Fed has to settle on its interest rate path as we go through the next few years, is going to be significantly higher than where they were, in the period, especially after the financial crisis.
And so, actually, now that you mentioned the Fed, we're at around 5.5% at the moment. There's some speculation we could have another 25 hike before the end of this year. That will take us to 5.75. Markets seem to be expecting pricing cuts for next year, and the Fed themselves, I think, within the SEP, within their own projections, expect some cuts next year. I mean, where do you stand within those projections?
Well, obviously, first of all, I suspect the Fed is probably done, but I wouldn't, stake my life on it, put it that way. I think they'll probably try and they will keep their additional hike in their forecast when they meet next week, but they'll probably pause. And then by the time we get to the end of the year, to say November, my suspicion is things will be weak enough for them to say, well, let's keep it going. Let's keep the pause going. For next year, I think it's a function of your growth outlook, putting it very bluntly. I mean, I mentioned earlier, my inflation picture does not have inflation coming down to target by the end of next year. So in that sense, you could say the Fed shouldn't be cutting. However, I think if as I expect, the economy is in recession, maybe in a mild one, but still in recession in 2024, then I think the Fed cuts. That's just the way the Fed will respond. It's in its sort of DNA and reaction function. And in fact, don't forget, in one of the recent press conferences, it may even be the last one, Powell was quite clear in saying we need to start cutting well before inflation gets to 2. He was very explicit in that. he was sort of saying we'd be waiting too late if we didn't move preemptively in some fashion. So there's this sort of mixed messaging a little bit coming from the Fed. They want to be clear that they're on top of inflation. They're still doing the job, but I think they've become a lot more receptive to the idea that at some point in this landing process they have to lift the nose of the aircraft. Otherwise, it's gonna be an ugly outcome.
I did want to pick up on one thing you said earlier about how you haven't revised your inflation forecast that much, if at all, for this year, next year, yet you've revised your growth forecast higher persistently. I mean, why hasn't your, the growth side impacted the inflation side of your forecast? I mean, surely they should kind of go together. I suppose there's a supply story, I suppose, behind that.
Yes, I mean, I think they go together if you think there's a one-to-one sort of Phillips curve mapping, but I think we've all learned that that's a very loose relationship. I mean, I've been, I won't say by definition, I haven't been surprised by the inflation data, but I've been sort of reassured a little bit more by the developments. I was nervous that things would keep going out of control, and I know you guys were definitely of that view, and it was a very reasonable view to have, especially if you had a little bit of historical context. I suppose I've just been reassured that the idea that we can move up a gear without slipping out of control was the right one, and I think that seems to be playing out. Of course, one thing I should emphasize, based around my framework of thinking about these things, is that in locking into a lot higher level as we sort of go through the, let's call it the next recession, it probably means that when we go into the next expansion, we're actually going to go even higher on inflation. You see what I mean? So one thing that I think is very important for investors to bear in mind is that that any coming bond and Fed-led interest rate rally, it needs to be seen in the context of almost certainly as persistently higher longer-term rates as we go through the next decade. And by the way, that has not just to do with monetary policy and inflation risks. It has a lot to do with bond issuance by DM governments, and of course, the lack of central bank buying of most of that bond issuance. We are not, like famous last words, but I don't think we're going back to a world of QE. That world has been discredited, and I think the bar on going back there will be very, very high.
Yeah, and just on the inflation path, this idea that you could have like a double hump in inflation, like you had in the 70s. So obviously we've seen the fall in inflation this year. How do you think about the risk of another rise in inflation happening?
It will happen. I think the obvious reason is because goods pricing is cyclically sensitive. So we're in a phase now of softer goods pricing, not weak, but softer. At some point in the next year, we probably will get even softer because of what I think of as a likely recession. And then we'll get a recovery. And at that point, goods pricing will bounce. We saw it even after 2009, at the depth of that recession. We saw a very strong bounce in global goods pricing in 2010 into 2011. It didn't last. This time, I suspect it will last, and therefore will become a concern relatively early on in the economic expansion, in the next economic expansion.
Okay, that's fair. Yeah, understood. Yeah, so it's not like we're going to head down towards 3 or 2 and stay at 2 for the next 5-10 years. That whole paradigm is we're outside of that now.
Yes. Absent something I'm not seeing, which is often a lot, but absent I'm not seeing, which would amount to a very positive supply shock. Very positive supply developments. I'm tending to sit on the other side and see supply developments as reasonably consistently negative for us.
And actually, on the positive supply side, I was speaking to one investor recently, and they were pushing me quite hard on this whole AI story around how that's a new technology revolution, and everyone's underestimating the impact that will have. And as a result, they argue that inflation will actually be way, way lower than everyone thinks, and persistently so. So it's like an AI positive supply shock. So when you hear something like that, how do you respond?
Well, I certainly, it's, I've done quite a lot of reading recently trying to understand AI, at least understand the macro aspects of it. And you can see it's very pervasive. And one thing that is very important about it is it's likely to affect productivity and especially employment levels in some core services sectors. So in other words, it's different from most of the technological improvement we've had over many, even centuries, that have tended to improve goods productivity, but sort of leave services as the sponge to absorb workers as they got released by the goods sector. This one will be different. And I think one thing that in some sense worries me about that is that it kind of raises some political stakes here. If we're going to see more and more middle class workers sort of laid off by companies saying we just don't need your services anymore, I'm not sure how they'll vote, if you see what I mean. I think they're more likely to vote, as we've seen in many countries in recent years, more likely to vote for good old-fashioned populism. And that actually takes me to a very important point, which is that it's dead easy to think of AI as boosting whole economy productivity. Everyone's got this dish, taps in their phone and gets great results and everything's fantastic. When you actually look at whole economy productivity, and I'm not just talking about the US, I'm talking about every major DM economy, and in fact, increasingly, it's spreading to the EM with China especially. What you see is just awful productivity developments. In the UK, productivity has actually gone down for much of the last decade. In the US, growth has slowed. Across the OECD region, we've seen, however you cut it, whatever time periods you slice it into, we've seen dreadful trend productivity growth in recent years. And I think that comes down to two factors. One is we're increasingly operating within our production frontiers, meaning the capital stock we've built, we're not using as well as we used to. And I think the pandemic had quite a lot to do with that. It's not the only factor, but I'll use that as my illustration. So in other words, we built all these offices, retail stores, and transportation networks, a lot of capital invested, and it's not being used, and that by definition, in some sense, is going to give you lower productivity. So maybe at some point we get back and start using them more effectively, but I wouldn't count on that. The other thing, which I think is even more important, and it's hard to quantify, but I think you sort of see it in lots of areas, is that productivity really is all about teamwork. And unified societies do well on productivity. There's a lot of anecdotes about how well economies operate during wartime. When everyone's pulling together, things go well. I think the story of the last, started with the financial crisis, but has continued, is sort of increasing political fragmentation within countries. It's almost like a done thing now to try and stymie the opposition. And of course that leads to lower productivity across the economy, I think. And I think that problem could get worse. And I'm not saying AI is going to cause it, but it could, because of this potential for job losses amongst many middle class voters who might then vote for more populism, more radical solutions, etc. I think it's not an obvious given that it improves aggregate productivity. It certainly helps the sectors using it do really well, and many of the firms operating do really well. But maybe that increases rather than diminishes some of these inequality stresses. So anyway, that's a big picture thought, but I think is a very important one as you sort of map it into the near-term conjuncture.
Yeah, that's a great point. I hadn't thought about the teamwork angle, but it does make sense what you're saying there. And I guess people talk about network effects, agglomeration effects, all these sorts of things. And underlying that is this idea of people talking to each other, relationships, and all of these sorts of things. So yeah, it's a fair point. And I think it's probably not as well researched as it should be. And again, I also think about the simple mapping that AI is going to be positive in every dimension is probably incorrect as well. The mapping to macro isn't so clear, I think.
Yes.
In many ways. That's fair. Let's move on to some of the countries now. I mean, you've had some strong views on Japan over the past year in terms of the inflation dynamics there. So perhaps we can start on your thoughts on inflation there, and then we can talk about the BoJ.
Well, in some ways, Japan is a perfect example of what I mentioned earlier, which is this sort of moving up of a gear in the inflation process. And in Japan's case, that means moving away from a slightly negative rate to a positive rate. I'd characterize inflation in Japan as having fully achieved the BoJ's target. They're currently running an inflation rate significantly above 2%. And, you could say, well, that was all energy and food and all this import stuff, but it wasn't. I mean, what's happened is that as we've gone through 2023 and got more data, we now have data through August from Tokyo. We've seen consistent increases in domestic core inflation prices. And you can say, well, will that last? I think the evidence is it's already lasted, and I don't see a great break back down again. In fact, I see a lot of, again, political pressure to raise wages and for companies to kind of begin to pass on higher prices to workers in the form of higher wages. Because that has a profit margin implication. And one of the points I like to make to people is Japan has actually now become the most profitable democracy in the world. Profit margins keep soaring, and they've done so significantly in the past year because domestic price inflation has risen, but domestic cost inflation has gone up by much less. So I think the next year is all about a rotation in that process, and domestic wages or local wages, which have already snapped back a bit, rising more significantly. Unlike most DM countries, which would view that as a problem, Japan, the BoJ especially, will view that as a success.
And so in terms of BoJ policy, what do you think? I mean, I guess the big question is, when will they lift negative rates? And there were some comments recently from Ueda which seemed to allude to that they may lift negative rates. What do you think?
Well, yeah, again, I've had the view in my forecast that they'll go from minus 0.1 to 0 in December. And then as we go through next year, each quarter add a quarter point. So that will end next year at 1%. That's been my forecast for a while. I haven't changed it. What I've got wrong is I keep sort of fussing around on my forecast on ending QE. And every time I get close to them thinking they're going to do it, I pull back and then they do it. So I've sort of learned, have discipline, Suttle, and stick with your view. So I mean, they haven't formally ended QE yet, but I think they're on the way. And I think the October meeting will frankly be an important step in that direction. The October meeting to me is very important because it will be, we're in an era where central bank forecasts are very much in focus. We'll talk about the ECB in a minute, perhaps, but the BoJ's inflation forecasts keep getting revised up each time they do it. And in October, they'll have another round. And I think that's the point where it'll be very hard for them. They'll have to revise up the current fiscal year yet again to well above 3.5, I want to say. I think I've forgotten they're currently at 3.2, I think, and they'll have to go, almost towards 4 based on the numbers we've already got. And at that point, it becomes very hard to say, well, next year it's going to be less than 2, and the year after that it's going to be less than 2. These central bank forecasts tend to get lifted in a parallel fashion at some point. We had that with the ECB, 6 or 9 months ago when they finally broke the dam on that. And I think the BoJ in October will make that adjustment. And that is the setup at that point, I think, for ending QE, but then in December for ending negative rates.
And 1% policy rate by the end of next year. I mean, it's 1% for Japan. That's quite a big deal.
Yes. I mean, it's a big deal because, in a sense, what I'm saying is I think the Bank of Japan will not only have succeeded in restoring inflation, it will have convinced itself that it really has succeeded, and therefore it can go back to the real world and not, the more normal world of policy rates. you could say, well, they tried that in 06, 07 and it failed because the world fell over. You could say having succeeded, it would then be 15, 16 years later. That's not a particularly magnificent achievement. You could say at some point it's inevitable that this happens. It's just because it's lasted for so long. I think it'll take many of us, it'll take many in the financial markets a long while to adjust to the concept that it can ever happen.
Yeah, no, that's great point. Now, let's move over to Europe and the ECB. I should say for our listeners that we are recording this a day before the ECB meeting, so all the disclaimers and everything we should have up front. But broadly, maybe we should talk about general trends here rather than talking about a specific meeting. But how do you characterize the growth inflation picture in the euro area? It looks quite stagflationary in some ways. So that's at least from my vantage point. But how do you see it?
Yeah, I mean, I think the ECB is lagging this US in the inflation cycle. I mean, that's been true for 2 years now, and still the case. So the US core inflation has rolled over from and it's down a few, not exactly how much, but a few points. The European process is just beginning. The big difference, however, is European growth looks much weaker. And I think a lot of that is the lagged effects from the shakeout or the fallout from the war with Russia, or Russia's war of aggression, whatever you call it. That was a big negative shock for Europe, especially for Germany. I mentioned earlier the problems that German car industry is having. But in addition, I think the German economy more generally is going through one of these sort of wrenching adjustments that is a big drag on the euro area. And from a euro area stability perspective, it's actually quite good because, the euro area gets into trouble when it's the southern European countries doing poorly. When it's Germany doing poorly, as was the case in sort of 04, 05, 03, 04, 05, that's a stabilizer for the region. But I think it probably errs the ECB on the side of being a little bit, I won't say dovish because that's probably the wrong word, but being content to want to see what effects its policies today will have on growth and inflation as we look into next year. And one important point to make is that in addition to the interest rate hikes we've had, of course, from -0.5 now to almost 4, so big net change. We've had a very large reduction in the ECB's balance sheet, including a big reduction in support of the banking sector. And that seems to be having a significant and pretty rapid pass-through into bank lending conditions in the region.
That's a very good point, actually. We forget how much they've scaled back on that side. That's a great point. And at the same time, the US had all the new credit facilities after the regional bank crisis. So it's almost kind of gone the other way there.
Yes.
No, that's great.
By the way, sorry, going back to the US, I should have mentioned that point that, you ask why are things looking a bit brighter as we went through the summer months? Well, the US did goose up the banking sector. It took away all the downside risk, and you could say got a bit fooled. The Fed got taken for a little bit of a ride by the major, not by the major banks, but by the banking system in aggregate. That sort of, in some sense, tricked it into providing a lot of underwriting. So that's a notable event, I think.
And then how about good old UK?
Well, I think the chart I always like to put up in front of people when talking about the UK is the wage numbers. This is the one country where I think you can say the labour market really has been at the forefront of the inflation process, and frankly continues to be so. And I think that's a reflection of the knock-on effects from Brexit, the dislocation that's had in the labour market, but also just, it's a country that's always had a tendency, at least in the last 30, 40 years, to have more wage inflation than most. So we've seen that effect come through. So I think it puts the Bank of England in a more difficult position than say some of its peers, including in the sort of non-European English-speaking world like Canada and Australia. Um, and I think the bank probably has to keep going at least next week in hiking, given what we've already seen. But I think the UK economy is under increasing amount of stress, and that's a good example of another economy, or another good example of an economy where the effects of interest rates will bite increasingly as we go through time. So even if the bank just keeps policy rates where they are, the pass-through of higher rates especially into the mortgage market, will become more significant as we go through next year and the following year. And the prospect of that, I think, will increasingly alarm consumers. So again, I think the UK is headed into recession over the next year. I mean, the bank had a view 6 months ago that if they ever put interest rates up to 5%, this would really hurt the economy and we'd have a recession. Then they did put interest rates up to 5%, and they took away the view that we'd have a recession because they said, okay, we don't seem to have problems at the moment. And I'm not sure that's a good way of forecasting, using the current picture as a way to think about what comes next isn't all, especially when you've made a big policy change, isn't always the best way to go.
And one of the sort of the big focuses in recent weeks and months has been China, where we seem to be having renewed weakness in the housing market. The data has been relatively weak, although recently they've stabilized somewhat. I mean, how do you see China?
Well, in a way, it's the inverse of the US view for me in terms of short-term developments. I'd been looking for China to have a strong start to the year and then to build on that with a sustained decline in consumer savings, lifting consumption, and providing decent domestic demand growth. Turned out that was wrong. We had a strong first quarter, and then quite quickly domestic demand faded. And as you point out, some of that is the problems with the domestic property development sector and the spreading of that, through the corporate world and presumably to households in terms of greater precautionary saving. But I think also it's just, we've reached a point in Chinese economic development where, fundamentally there's a slowing in growth underway. And it's that slowing that's making domestic producers and especially domestic consumers more nervous. Instead of extrapolating good times, they're now beginning to get more worried that maybe the growth won't be there. And the obvious example of that is the seeming rise in unemployment amongst younger people and the lack of good job prospects for the young people coming through from universities and education more generally. And I think that's a new development and something that kind of intensifies the pressures on China. You say, well, their traditional approach to this is just thrust more stimulus into the pipeline. They're not doing a lot of it, but they're doing a lot of different little things that in some sense are adding up to a nice plus. And that's, as you mentioned earlier, that's showing in some of the numbers. But I worry that, fundamentally, the only way they can really turn growth back up is through a sort of change in the political philosophy here. And for Xi either to go, which is probably unlikely, but you should never say never, or to radically change his policy and kind of move back to a more a style of promoting the private sector and private sector investment. Because the other thing that's changed for China is the US attitudes and Western attitudes with sanctions and restrictions. And that's obviously been a drag on the private sector's ability and willingness to invest.
Yeah. And now if we zoom out a bit and think about central banking as a whole, I mean, 10 years from now, when we look back at this period, I mean, what do you think we'll write about central bankers?
Well, I think there'll be a growing recognition that it wasn't just this period that went wrong. It was everything that was done sort of after the middle of the last decade, especially, but I think possibly even starting after the financial crisis. I mean, you could argue it's hard to fault anyone for what they did during the financial crisis and its immediate aftermath. people like Bernanke were heroes and they did some great stuff in rescuing the system. But then what came next was excessive support and, almost like an overreach of monetary policy. And I think the theme of the next decade will be that we need to be more respectful of what monetary policy can and can't achieve. And, frankly, be a little more, I mean, we hear this word a lot now amongst some central bankers at least, be a lot more humble about what we can do. And I think that speaks to the idea that central banks will be a little more cautious in the next upswing, or certainly more cautious in the downturn. They won't be as aggressive, and more cautious in the next upswing.
Okay, yeah, no, great. That makes sense. Now, I did want to sort of pivot to some more sort of personal questions. One
Yep.
I always like to ask every time we meet is, have there been any good books or TV shows or anything that you've consumed recently?
Well, of course, I have to point out that since we last talked, my favourite soccer team, Luton Town, is in the Premier League. It probably won't last, but we're at least there for 1 year. So I'm definitely watching a lot.
Well done on that.
Yeah,
who'd have thought?
definitely watching a lot more soccer on television. To the extent one can. But on
Any Luton players sold to Saudi yet or not?
Well, not exactly. I think we're in the next 2 or 3 tiers down. We're not quite there yet. But more to the point, on your question about books, I read one of the best books I've read in a long time over summer, which is a book by a guy called, actually I know him from World Bank connections, a UCLA academic called Sebastian Edwards. He wrote a book called The Chile Project, which I think is fascinating. I would urge everyone to look at it, because it's essentially, the subtitle is something like the rise and fall of neoliberalism. And it's really all about the way that Chile became, after the Pinochet coup, became this case study initially in sort of how to do radical right-wing policies. And then once the left took over after Pinochet went, how those policies were sustained and deepened and turned into this wonderful new model, which would be a great success. And that's the rise bit of it. But what he documents quite neatly, I think, is the way that has all fallen apart in recent years, and the implications of that, and including especially why it fell apart. And I think it's a really, you say, who cares about Chile? It's a small place in Latin America. No, it's actually almost like the lead. We used to think of New Zealand as a leading indicator for the DM economies. Chile, in some sense, in this front, on the supply side, is a good leading indicator of some of the stresses we're now seeing develop in the DM economies, including especially in the UK and the US, and the rise of populism, the return to more unorthodox policies is something. In Chile's case, it was the left taking back over again after the extreme left, the student leader BoJ becoming prime minister, a decade after he led massive protests in the streets. This is the sort of dynamic I think we're going to see increasingly playing out. One of the big things about Chile is the disaffection with the pension system. This so-called wonderful private pension system they developed and everyone thought was going to be great has turned out to be a big disappointment. And you can see that issue looming in the United States, where more and more people are going to face retirement without adequate income in coming years and decades. And going back to my AI point, I think that could produce increasing amounts of sort of populist political backlash. So yeah, the Chile Project by Sebastian Edwards to me is a must read for
It sounds great. And is it written for a general audience, or is it written for more of an academic audience?
No, it's surprisingly unacademic. I mean, the good thing about it, which I found fascinating, was how well he was involved in a lot of this stuff. He's a Chilean who's been he was a teenager when the coup happened, and kind of in on the lower levels, not involved in the coup, but involved in the economic research activities going on at the time. And it's just a fascinating documentation of how things played out. And as I say, it's sort of it reminded me as I read it, okay, this is sort of New Labour in the 90s. You know, this was what New Labour was proposing were many of the same policies that Margaret Thatcher introduced in the late 70s, early 80s. And then we've sort of seen growing disaffection with that. And in Britain, it showed up not in student unrest on the streets and pension problems so far, but in things like Brexit. So you've seen this cycle playing out, this movie playing out across many similar countries.
That's great. I'll make sure to read that. And to be honest, I haven't heard of the book, so it's good that you flagged this one. I'd be looking for a new book to read. So with that, what's the best way for people to follow your work?
Okay, I mean, I do a lot, and the best way is to ask for a trial subscription to our work, which is you can ask through the website suttleeconomics.com, or send an email to admin at suttleeconomics.com, and if you're not already a subscriber, we'd be happy to sign you up for a trial and get you a sense of what I do and how I do it.
And I do urge listeners to definitely make use of the trial. I mean, I think Phil produces perhaps the best global economics daily out there. I'm an avid reader of it for years, for decades actually. You've been writing in some form or another in different institutions, and so it's the best.
You've exposed my secret, which I'm a one-trick pony and doing the same thing, and eventually I'll get it right. But no, seriously, I think you found your niche. Everyone has to find their niche, and specialize in what they do. And if you want a daily economics product, I'm probably as good as it gets.
Yeah, I agree with that. So with that, thanks a lot, Phil, as usual. Great insights, and good luck for the rest of the year.
Wonderful. Thanks. So good to talk to you, Bilal, and same to you. Bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.